We just finished going through Lumentum Holdings fiscal 2026 fourth quarter earnings call materials, and now we want to share our takeaways with everyone. Here's the question you're already asking, and I know you're asking it because I was asking it too. Is the AI optics trade still real, or did we all turn up 2 years late to the party? That's what we're cracking open today, and I'm telling you, this one answers it in a way I did not expect, because the fight this quarter is not about whether anybody wants the product, right? Let's get into it. The company's stated revenue came in at 1.01 billion for the quarter, up over 9% year over year. That is a doubling and is a milestone the company says it reached a full quarter ahead of its own plan. Now here's the line that actually made me sit up, and it is management's own message, not mine. They simply cannot manufacture product fast enough. So the question hanging over this quarter is no longer whether the demand is still there. The question is whether Lumentum can build it fast enough. And I'm telling you, that is a completely different animal. Our take is that this is the better of the two problems, but don't mistake it for a good problem. A demand problem you fix with salespeople. A supply problem you fix with factories, and factories take years. I'm about 80% on this being the single thread that runs through everything else we're about to cover. Quick word before we keep going, because people ask what Radar trades through. It's Interactive Brokers, one account reaching the US, Japan, and the other majors, which is what you want tracking a supply chain across borders. Links in the description, and straight with you, this is a paid promotion. Promotion, we're a customer, they pay per click. Not advice, investing carries risk, do your own work, and back to it. The filing shows a GAAP net loss of 7.2 billion, and I want you to sit with how big that number is. Then throw it away because the company says it was driven entirely by a strategic conversion of 35% of its convertible debt into equity. A 7.8 billion non-cash charge ran through the books, and 1 billion of convertible debt vaporized off the balance sheet. Here's the reality check the company puts up against it. A GAAP gross margin of 47.4% and a GAAP operating margin of 27.80%. You do not print a 27.8% operating margin while you're bleeding out. Now, the bears would push back here, and they'd be right to. Turning 35% of your converts into stock means somebody's ownership just got smaller, and that somebody is you. The company also states the cash impact was negative 44.30 M, taking cash to 2.74 billion, purely to facilitate that restructuring. Our read is that they traded real cash and real dilution for a lighter debt structure, and on those terms it was worth doing. Start with the problem the company puts on the table. Copper connections cannot handle the speeds an AI cluster runs at. The move to optical fiber is not a preference, the company calls it mandatory, and that word is doing a lot of work. From there, the business splits in two, and the split matters more than most people realize. Components did 60/40 IM in the quarter, selling raw laser chips to the companies that build transceivers. In pump lasers, the company puts its share at 70 to 80%, which is not a market position, that's a toll booth. Systems did 13,257 EM, selling the finished article, assembled transceivers and optical circuit switches. Think of it like a car plant that also sells engines to the guy across the street. The engines carry the margin, the finished cars carry the volume, and you really want to be in both. Our take is that owning the chip is what keeps this company from ever being just an assembler. Here's the whole moat in one idea, and the idea is a dartboard. The company frames its competitors as low consistency and high waste, and itself as extreme precision. The claim is delivering extremely narrow specification limits at massive industrial scale, and scale is the hard half of that sentence. Anybody can make one perfect laser. Making millions of them land on the same tiny dot is a different sport. Here's the economic translation the company spells out. Narrow laser specs mean higher manufacturing yield inside the customer's transceiver. So the customer isn't paying for a component. The customer is paying to not throw parts in the bin. The result the company reports is a significant price premium and gross margins past the 50% mark. And that's happening despite extreme cloud vendor consolidation, which is the part that should get your attention. By industry logic, when a handful of buyers control the market and margins still go up, the supplier has something they cannot get elsewhere. Management modeled that hitting 50% margins would require 2 billion of revenue. They hit 50.4% at just 1.01 billion. Read that again because they did it at half the revenue they said they needed. Operating expenses were held at 130.1 M, which the company notes is only 13.7% of revenue. Operating margin landed at 36.6%, up 260 basis points year over year, on the non-GAAP basis being measured here. Here's the honest part, and the company ranks it themselves. The number one margin driver is product mix, number two is factory utilization, and pricing power sits at number three, mostly still ahead of them. Our read is that this cuts both ways. Mix and utilization can reverse on you, so the leverage is real but not locked in. The upside is that the biggest lever, raw pricing power, has not even been pulled yet. The company guided fiscal 2027 first quarter revenue to 1.215B to 1.275B, up 130% year over year. That is a September quarter, not a calendar year opener, and you have to keep those two straight here. Operating margins guided to 39.5% to 40.5%, and earnings per share to 4.05 to 4.35. Now hold that against the old target model, 30% to 42% margin at 2B of revenue. They're guiding into the top half of that band at roughly 1.25B, so the model isn't being beaten, it's being broken. The company calls it a double acceleration, a corporate milestone hit over a full quarter early, and a long-term margin model that now needs a rewrite. And the CFO's signal is the loudest thing in the whole update. 42% should now be viewed as the midpoint. The company says the entire long-term model shifts up 100 to 200 basis points by the next OFC. Our take is that a CFO who pre-announces a target raise already has it in the bag. 4 product lines, and every one of them is running hot at the same time. 200G AMOLED is now more than 25% of AMOLED revenue, and the company expects it to cross 50% of volume by the middle of calendar 2027. The company also projects Q4 unit growth above 50% year over year, and since fiscal Q4 just closed, a reasonable read is the December quarter. CW lasers got their die size cut significantly, closing the gross margin gap with the EMLs, and the company calls it purely accretive long-term. Pump lasers shipped up 80% year over year and are functionally sold out, with volumes expected to grow 4x in coming quarters. You don't get to the words functionally sold out unless the order book is genuinely past what the fabs can do. Narrow line width has now put up 10 consecutive quarters of sequential growth, up 130% year over year, the most consistent engine in the group. Our take is that 4 cylinders firing at once is rare, and it is exactly why the supply problem is this bad. 2 things to track here, and both are about to collide with the supply problem. 800G is hitting record highs, and 1.6T is shipping on schedule, which is not a sentence you always get from an optics vendor. The company expects the 1.6T adoption curve to steepen significantly in fiscal 2027 first quarter and sustain through calendar 2027 as Tier 1 clouds deploy custom AI clusters. Then there's the optical circuit switch, and this is the piece I keep coming back to. The company reports OCS shipments doubled sequentially, and its fiscal first quarter guidance assumes the first ever 100M plus quarter for that product. It also self-identifies as the only commercial merchant supplier with actual shipment history, and expects to be the #1 volume supplier by early calendar 2027. That's a monopoly claim in the company's own words, and monopoly claims age either very well or very badly. We suspect that first 100M quarter is the cleanest single thing to check next time, and I put myself at 65% that they get there. Now, where the architecture goes next, and there are 2 roads. MPO is the stepping stone. The company puts it in calendar 2027 and 2028, and it trades efficiency for faster time to market. And here's the important part. The company frames it as a purely additive market that expands the total market rather than cannibalizing anything. It does require scaling 400W laser technology down to 150 to 200W, which is engineering work, not a science project. CPO is the destination. The company puts it at calendar 2028, says lead deployments are on track and demand signals have strengthened. First external laser source orders are secured, which is hard evidence rather than a promise. And here's the cold water, and it comes from the company itself. Current SerDes speeds are too slow for both architectures. Both absolutely require the calendar 2028 next generation processor and rack cycles with no retrofitting of existing chips. So the honest read is that the big architectural payday is a 2028 story, and 2028 is a long way from here. Here's the thing that decides the next 2 years, and it isn't a happy one. The company states the EML shortage remains unchanged, and the high-power laser gap has actively deteriorated. Deteriorated is their word. Not stabilized, not improving, and they said it anyway. Then comes management's clarification, and I think it's the most important quote in this entire update. They said, our ramp execution is on plan. We are further behind because demand accelerated. 3 emergency interventions follow, and you can tell they're emergencies by how specific they are. The Japan MP fabs are outperforming with the excess pushed into CW lasers, and the US Greensboro fab conversion to MP is on track for calendar 2028. And they've newly signed an AXTMP substrate contract, which the company notes reverses last quarter's stance on substrate security. A company that reverses its own position in 1 quarter is telling you the pressure is real, and our take is you should believe them. Now let's put management signal next to the second level read, one at a time. Signal 1, Optics are eating copper's territory, and to be fair, the company has a point here. Optical content per rack really is rising structurally, but realizing it means waiting for the calendar 2028 silicon cycles. Signal 2 CPO is unchanged and MPO is an upside bonus. The read is that MPO is an agnostic hedge because both architectures need Lumentum lasers, though MPO is a power compromise that may be short-lived. Signal 3, and this is the one that matters for your model, margins hit 50% through unique technology leverage. The second level read is blunt. The current lift leans heavily on product mix and factory utilization. With vast new capacity coming online, holding that leverage will take raw pricing power. And pricing power is the thing they said is still ahead of them. Truthfully, I cannot call that one yet, and anyone who tells you they can is guessing. Here's where the analysts spent their questions, and the question count tells you what the market is scared of. 5 inquiries went to capacity, substrates and supply gaps, more than any other topic. And the company did not dodge. It admitted the gap worsened and pointed to newly signed substrate deals. 3 inquiries each went to 3 other places, starting with the NPO and CPO timelines. Management suppressed the near-term hype there and confirmed calendar 2027 and 2028, which is discipline, not weakness. On OCS dominance came a rare concession, and I want to quote it, "We are chasing the 400 M goal." But I wouldn't say we are ahead. On margin targets, they pushed the formal reveal to the next OFC, while effectively raising the floor anyway. 1 single inquiry went to the unseen threat. The China MP fabs and management gave a firm denial with no actual shipments detected in the market. Our take is that one question is exactly one question too few on that topic. 4 warnings, and the company calls them structural. 1. Customer optionality. In a shortage, customers will take any light source they can get their hands on. If supply ever loosens, pricing power and product choice go straight back to the cloud giants. 2. The time gap risk. The explosive CPO and MPO growth is hard tied to calendar 2028. Until then, the company has to bridge the story with 1.6T and OC execution, quarter after quarter, with no room to miss. 3. The substrate squeeze, and management said it out loud, fine for this moment, but in a quarter or two we might need more substrate reinforcements. 4. The cash and capacity war. Capital expenditure ran 167 M, inventory swelled by 59 M, and cash dropped by 430 M. The company notes take or pay contracts are critical to funding the expansion, which means customers are being asked to put money where their forecasts are. I've been wrong before by falling for a great product story and ignoring the balance sheet, so I'm not doing that here. The company leaves us 10 things to watch, split by how far out they sit, and this is the part I'd actually write down. Short term, through the first half of fiscal 2027, did OCS revenue breach 100 M in the fiscal first quarter? Is the 1.6T share of shipments noticeably spiking? And did the December quarter hit that above 50% year-over-year EML volume target? Midterm, through calendar 2027, is the high power supply gap shrinking or widening, which the company calls the most honest thermometer of demand? Did the 200 GML mix cross 50% of volumes by mid-calendar 2027, and are new long-term MP substrate agreements actually landing? Long-term into calendar 2028, did ultra-high power lasers clear 50 M a quarter by late calendar 2026? Did the new OFC margin target anchor at 42% or better? And are Chinese competitors finally shipping real NP volume? Notice how many of these are supply questions and how few are demand questions, because that is the whole story of this quarter. Alright, last thing, radar always leaves you a light. I'm calling this one yellow, and let me be precise about why. The business is flat out impressive. They beat their own 50% margin model at half the revenue it was supposed to take. But the thing giving me pause is not the business, it's the gap between now and calendar 2028. So the explosive architecture growth is tied to a silicon cycle 2 years out. The high power laser gap is widening, and cash went out the door this quarter. Here's what flips me to green, and I'm telling you up front so you can hold me to it. If OCS clears its first 100 mm quarter and the high power supply gap stops widening, I go green, and I'll say so out loud. If the gap widens again while all that new capacity lands, I go red, and I'll say that out loud too. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar, hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.